Welcome to this week's Emerging Markets Update. I'm Nick Pardini from Emerging Market Insider and Nomadic Capital Partners, and I'm going to welcome you to our first edition of this update. We'll be releasing one of these every Friday. The three news stories will be available publicly on YouTube and on Emerging Market Insider every week, whereas the rest of the analysis will be available publicly for the next 2 weeks, but after that will be limited to subscribers of our upcoming Emerging Markets newsletter. The first news that we're going to talk about is the turmoil in Egypt is continuing to accelerate. Port Said has been lost to government control as of I've last talking on this on February 1st. This basically all started in November when the President Mohamed Morsi announced that his actions are not subject to judicial review, which the public has reacted against this as an abuse of executive power. And since then, there's just been consistent protesting since November, and it's been getting increasingly violent. And the country is becoming almost ungovernable. A lot of the military officials recently have said that this could possibly lead to the collapse of the state of Egypt. And the stock market has reacted pretty adversely in spite of rallies everywhere else in the world because of this unrest. Egypt is down 21% as I'm saying this since its peaks in September. And I expect this to continue. I would maybe things resolve itself rather quickly, and the hope of a resolution is enough to drive up an emerging market stock index such as Egypt. However, the rest of the world is pretty overvalued here, and a sell-off in the United States or in Europe or in emerging Asia is going to have capital flows flowing out of more rogue emerging markets such as Egypt, which can hurt it. And also, as you have no idea what's going to happen here. Things could get progressively worse as well when it comes to this unrest in Egypt and drive down Egyptian stock prices even further. I just recommend investors staying away from Egypt right now. The Middle East is the most geopolitically sensitive hotspot in the world, and I would not be surprised if there's more international violent conflicts in the region. That's what's been happening in places such as Syria and Egypt and Libya in the past, and now in Mali. And the Middle East and North Africa is just currently unstable. And outside of Morocco, there really aren't that many solid countries worth investing in this region. Our next news story is a Caterpillar's accounting probe in China. Basically, due to some false accounts, Caterpillar is going to be losing hundreds of billions of dollars due to accounting fraud related from supposedly fake Chinese buyers in the region. This is basically, it shouldn't be too much of a surprise with somebody who follows emerging markets because China has a reputation for accounting issues. Plenty of Chinese stocks listed in the U.S., just dear consumer products, have been identified as frauds, and just China, this is just part of business out there. Accounting is not very credible. Shareholder rights are very limited in China. There's still plenty of growth opportunities in China, but investors have to be very careful and diligent with financial statements, particularly with stocks not listed on the Hong Kong exchange, which has much more diligent requirements for listing than the NYSE. This also may be a sign that China's growth is more of an accounting trick, at least, than actual substance. A lot of China's demand supposedly for raw materials and from construction, if a lot of this Caterpillar orders were indeed not real, then that means there's less demand for construction in China than previously thought. In addition to this, based on talking to people out in the natural resources business in Asia, that commodities such as copper and iron ore are actually used as collateral for debt. And that's why you see a lot of stockpiles of copper and iron ore and other hard assets in warehouses all over China. Because you're like, how are you going to use all this? Well, they're using it to basically maintain financing because creditors in that part of the world do not value just paying back unsecured debt. And so the copper reserves are used as a way to secure this debt. And this is why there's a lot of commodity buying still going on in China. I still think a hard landing is likely in China, but I think for at least for the next quarter, you can see Chinese stocks rallying, and Chinese economic numbers look better because of stealth stimulus measures just to keep the renminbi down. They're just putting more money into the circulation into the Chinese markets. So I expect it. I'd probably say fade China into March, but for right now, uh, it could last for a while. China still has to restructure to a consumer society, and the longer they delay this, the longer it's going to hurt investors in the meantime. And our final news story for emerging markets is Colombia and India have both cut rates. Inflation is pretty low in Colombia, so I mean, and growth is struggling. So I could see why Colombia would cut rates, and it may be a little bit of a boost to the Colombian economy and the stock market, but I don't think that it's going to be any severe inflation risks right now going on there. India, on the other hand, is a different story. India already has pretty high inflation at around 6%. Nevertheless, growth is still slowing in India, and I expect growth to continue to slow in India because they have fundamental infrastructure problems and have to deal with overcrowding of the country. India is about this like 1/3 of the size of the United States, but it has 4 times the amount of people as the United States, and this is as a result they have severe infrastructure problems dealing with overpopulation and other factors. Like last year, for example, with this power outage, half of India's population lost electricity. I mean, they don't. There's a lot of strains, and there's really not much being done to fix these. Roads are in terrible shape. I mean, like a big highway in India outside of New Delhi is maybe like one lane, paved lane on each side, where you still have um, drivers of camels with like a truck behind it full of logs, and that's something you still see on the road in a place like India. And water sanitation isn't the best there, so there's water shortages. These things the government is trying to deal with, and they are trying to make reforms to open up their economy to improve economic growth. However, due to the deep-seated like left of center political interest, it's going to be hard to have these reforms actually be implemented. In addition to that, uh, inflation still remains high because the Bank of India does not have a very credible central bank and a track record of keeping inflation down. And track record of central banks is something that is very important, that even like countries with equally loose monetary policies would be treated very differently in the currency markets based on the historical track record to keep inflation down. That's why so like Bank of Japan and the Fed more or less can get away with more easing than an emerging market country who has a bad track record of printing money, such as Turkey or India or Argentina. And if India, I expect inflation to go up even higher. India and growth maybe to improve, but probably continue to slow because of they're not able to resolve infrastructural problems and deal with other problems related to overcrowding and geopolitical issues. But that does not really affect rates. So we'll talk about the geopolitical structural issues in India at another time. Now let's move on to our next thing. We're talking about which emerging markets I think have the best chance to outperform in 2013. And the four that I think are stand out that are liquid to investors. I mean, there's other frontier markets that have a lot of opportunity too, such as Mongolia, Myanmar, Sri Lanka, um, and some parts of Africa, but they are extremely illiquid, even for people who are willing to take the risk of trading outside U.S. exchanges. Like a lot of places such as Kenya, which has a lot of opportunity, you're gonna have to get a full service broker, which is a minimum of $75 a trade plus a commission of the percentage of the orders. And it's just something that I'll probably talk about these more illiquid frontier markets in another episode. But for right now, let's just stick to ones that are more tradable for American investors. And the ones that I'm going to talk about this time are Vietnam, Chile, Indonesia, and Mexico. These countries have been largely ignored by fans of the BRIC countries. They are progressing to have increased the degree of their open economies and are also becoming more open to foreign investment. And however, they all have certain problems that have been holding them down. Vietnam is just mainly a corruption issue. Indonesia is also a corruption issue, and the fact that it's losing its status as one of the world's oil exporters and becoming a net importer of oil. Mexico is the drug cartel issues, and Chile has to deal with declining copper demand. So those are the reasons why a lot of these markets had previously underperformed the BRICS. But right now, I think there's a lot of good opportunity. I mean, these would take a whole episode to go into each one of them. So this one, we're just gonna talk. Now, these are the bullish drivers for Vietnam. Vietnam does have a lot going for it as a country. It has a very low GDP per capita, less than $2,000 per citizen, and it has 80 million people. So if income goes up to say $5,000 per person, that would be a huge economic boom and a lot of money to be made for investors. Uh, it's also Vietnam serves as a cheaper alternative to China for manufacturing. A lot of shoe companies have moved down to Vietnam from China to relocate their textile manufacturing. Uh, Other clothing companies have done this similar moves, and as the Vietnam workforce continues to gain more skill, and the government gets more credibility that like people won't get their factories seized, you'll probably see more capital moving out of China and more factories and manufacturing moving to Vietnam because wages are significantly lower. Chinese wages have skyrocketed, whereas Vietnam's wages remain cheap. And they're able to remain so cheap because cost of living is very cheap in Vietnam. Basically, the nicest hotel in Vietnam off season goes for $150 a night. You can easily eat in Vietnam for $1 a meal. A cab ride is going to cost you no more than $2 to go from one side of District 1 of Ho Chi Minh to the other. Uh, and Ho Chi Minh is fairly expensive compared to the rest of Vietnam, with the exception of Hanoi. So, uh, there's the thing is they don't need as much income to live in Vietnam versus the United States, and even with rents, supposedly have gone up a lot for retail outlets, but residential is very cheap still. Like again, you get a luxury apartment in Ho Chi Minh City, two bedroom luxury apartment for $500 US a month, and so just the cost of living and everything is extremely low, and so if wages do go up, that translates to disposable income. And the whole thesis of the great convergence that I've talked about with nomadic several times is basically the idea that real standard of living is going to converge between the emerging and the developing world. And even if the Vietnamese guy makes a lot less than an equivalent American, they may be a lot closer in terms of purchasing power due to lower cost of living in Vietnam and a growing economy, so they can save and invest or just consume more. Whereas the U.S. Worker has to just pay off debt or taxes. Things to watch for in Vietnam. A few that basically we have to get started with is that the MGM Grand Ho Casino opening is going to be a big test for the success of foreign direct investment in Vietnam. Whether this thing succeeds or fails is really going to have a huge influence on the Vietnamese government's willing to open more foreign investment. However, like based on the boots on the ground that I know, There's a good chance that this casino fails. First of all, it's located on a beach that's not exactly the most desirable um, resort spot in Southeast Asia. Uh, there's Bali, lots of beaches in Thailand, whether it's more famous ones such as Phuket or more obscure places such as Koh Samui or Krabi, or smaller beaches in Thailand which are much better quality. There's the Philippines, and I mean, and Singapore offers it does not really necessarily a beach tourist spot, but it does offer a lot of like more first world amenities for tourists in this region. Whereas Vietnam's is not as good a quality on that as in terms of a draw for beach going tourists. Other thing is that locals will be entirely banned from gambling. So any revenues generated from this casino have to come from foreigners. However, they do allow foreign residents of Vietnamese descent to go to the casino. But the thing is if you ban all of your locals to go to the casino, it's going to be hard for MGM to make money. And that's because there's a lot of competition for gambling too in Southeast Asia. You've got Macau, which is about a 3 hour flight away, and it's a lot closer for Chinese investors, not investors, Chinese gamblers, sorry, to go and play their card games or their slots. You got Singapore, which is the second biggest gambling market in the world, ahead of Las Vegas, which is also a pretty big draw. I mean, for gamblers as well, and it's just a nicer infrastructure and city to go to than Vietnam. And casinos are being gambling restrictions are just declining all across the region outside of Islamic countries such as Malaysia and Indonesia. So it might be a stretch. I mean, it might be hard to convince people to go to Vietnam who aren't Vietnamese just to go gamble. I mean, maybe it might, due to the lower cost of living, it might be cheaper. But again, it's a Laughlin versus a Las Vegas thing on that. And I mean, people don't want to go gamble who afford money to go blow on the casino necessarily aren't going to want to go just to the cheap low end spot. So I'm really unsure about how this will succeed. Other things to look out for is a big banking scandal going on in Vietnam. Several bank directors and heads of leading agricultural banks have been arrested. One most recently this past week for embezzlement and fraud related to their banks. That's why the Vietnamese stock index has declined recently, about off the highs, and it triggered severe sell-offs when these first got discovered late last year. If you don't have a stable banking system as a country, it's going to limit growth because it's going to be tough for growing businesses to get and for investors to get financing to develop the country. And also, it scares equity investors out of the market because if the banking system is not credible and corrupt, then volatility in financing and interest rates can severely hurt the value of any investments. It looks like this is not over yet, based on the fairly recent arrests going on when the market previously perceived that this problem was done. And so we have to watch out for what's going on there. And the thing is, with these headwinds and positives at the same time, when is the time to buy VNM? VNM is the Vietnam ETF. It's the most effective way for investors internationally to trade Vietnam. I mean, you can set up an account in Ho Chi Minh City Stock Exchange, and it's not that expensive per trade basis. It's about $15, and a small, like, 2 basis points of capital. So it can be tradable, but the thing is that based on the recent banking scandals and just the corruption record in Vietnam, statements aren't the most trustworthy. And to kind of hedge that risk, you could investing in an index is probably the best way to play it. And now we're going to look at the stock chart of Vietnam. Vietnam bottomed in December at around $15 a share, and it's rallied 40% since then. And so this might not be the best time to buy, especially with more allegations coming out relating to its banking scandal. Uh, I would say that Vietnam can correct pretty harshly. I don't think it'll get back down to 15, but it can easily get back down to say 18 at least. Go down another um, $3, maybe even as low as 17. But I would be just hesitant to buy here because even with this recent correction, there's still a heavily overbought sentiment technically with Vietnam, and also we have to still see the success of MGM's casino because that comes out. That's going to be open to the public this month, but it'll take a while before we see the success of foreign investment. If this thing fails, it's going to, I mean, based on just assessment of investment community out in Asia, it's going to discourage foreign investment. I mean, foreign investment is already pretty strict, like in terms of regulations. Like, there's a reason why there's no McDonald's in Vietnam is because the Vietnamese government has strict requirements of compliance that require a project to return significantly higher amount than any other countries simply because of strict restrictions and costs and corruption dealings that you have to associate with entering the Vietnamese market. So maybe if the foreign direct investment eases, if this casino succeeds, it'll create more of a FDI boom in Vietnam, or it can go the other way around. So that's basically what my reason for waiting on Vietnam, but it's definitely on my watch list, and I'll update followers when the time actually is to buy Vietnam. And then the last side, we're going to talk about just upcoming products from Nomadic and Emerging Market Insider. Just in conclusion, first, when it comes to Vietnam, I'm very optimistic on the long term of Vietnam due to its low base, growing consumer society, and they may even have their currency more stable after raising interest rates to control inflation, which was previously at as high as 20%. It's now down to 9%. So it may look like inflation might be stabilizing, but it's too early to call on that. That's another thing to keep an eye on because inflation of the dong was pretty high, and the valuation of the currency. There's been a boom for manufacturing, but it has hurt consumer purchasing power in the country. But a currency book I'm writing about emerging market currency is not going to cover the dong because it's semi-pegged to the U.S. dollar and it's not very credible. But be covering plenty of other emerging market currencies. That will be coming soon. I'll update followers and viewers more about that as it comes. And then our emerging opportunities newsletter will be released in 2 weeks, February 11th, 2013. And in that, we're going to cover the best investment opportunities in emerging markets and emerging technologies, and along with macro commentary that I normally provide just to investors within Nomadic. Yeah, and we'll probably talk about more details on that, such as packages and pricing on our website once the newsletter is actually released to the public. But it's just something to keep in mind of if you like products on an analysis on Emerging Market Insider and for my commentary on Seeking Alpha. Thank you for watching this video, and I'll have another one out next week.